Welcome to the Money Mindset Podcast. Here we break down finance, investing, and smart money strategies in a simple way.
Picture this. It's 1970, you are a factory worker, and you've, diligently scraped together $10,000.
Which was a pretty massive amount of money back then.
Right, exactly. And you were standing at this ultimate American crossroads. Your neighbor leans over the fence and says, buy a house, real estate never loses value.
Yeah, the classic advice.
But then your brother-in-law pulls you aside at the family barbecue and whispers, put it in the stock market. That's where the real money is.
And fast forward over 50 years, and people are literally still having this exact same argument.
On Reddit, at dinner tables, everywhere. We are still screaming at each other over which path actually builds wealth. So today on this deep dive, we are stripping away the emotion, the family lore, the internet hype.
Which is so desperately needed.
Exactly. We're looking at a century of hard math from a really comprehensive financial blueprint to finally settle the score.
Okay, let's unpack this. Why is this debate still so intensely personal for people? Well, it's because most people do not invest based on evidence. They just don't. They invest based on deeply ingrained psychological comfort. Like, look at how people interact with real estate.
Right.
It offers this visceral, tactile safety. You can physically touch the brick. You can inspect the roof.
You can paint the walls whatever color you want.
Exactly. You can stand inside your investment. It feels permanent. But then, on the other end of the spectrum, you have the stock market. People often pour money into equities because they're chasing the adrenaline of a story.
Oh, like the tech stock that jumped 400% last year.
Right. They hear about that and they want the rush of a lottery ticket. It's exciting.
Okay, but neither the tactile comfort of a brick wall nor the adrenaline of a hot stock tip is an actual investment strategy. When you strip away the stories, it's basically just gambling with a really compelling narrative attached to it.
It absolutely is.
So if we want to cure this habit of emotional investing for you, the listener, we have to establish a historical baseline. Let's look at the cold, hard numbers our sources provide. Over the last 100 years, the United States stock market, specifically the S&P 500, has averaged a return of roughly 10% per year before inflation.
Which is incredibly strong.
Right. And after inflation, you're looking at a reliable 7% annual return.
Yeah, it's a very consistent, historically validated engine of economic growth. It just chugs along.
But then, and this is where it gets crazy, we look at the real estate data. This is pulled from Nobel Prize-winning economist Robert Shiller, who literally wrote the book on housing bubbles.
Oh, yeah. Shiller's data is legendary.
His data shows that the average annual appreciation of U.S. home prices after inflation is a mere 1% to 2% per year.
Just 1% to 2%?
Wait, so what does this all mean? If stocks win 7% to 2%, why are we even doing this deep dive? Are real estate investors just terrible at math? That doesn't track with reality because we all know wealthy real estate moguls.
What's fascinating here is that looking purely at baseline appreciation is a massive trap.
A trap? How so?
Well, the numbers are historically accurate. Shiller is right. But they completely ignore the underlying mechanics of how real estate is actually purchased in the real world. Comparing the pure percentage growth of a stock index to the pure percentage growth of a home's value, it's an apples to oranges comparison.
Because of how you buy it.
Exactly, because of one crucial element, which is leverage.
Real estate's secret weapon. So moving from raw percentages to the actual mechanics of buying property reveals exactly why real estate punches so far above its weight class.
Right. To understand leverage, you really have to look at how a purchase is structured. When you buy, say, a $300,000 house, you rarely use $300,000 of your own cash.
Right. Almost nobody does that.
No, you put down a fraction of that, say a 20% down payment, so $60,000.
And the bank loans you the rest.
Exactly. You are now controlling a massive asset using mostly other people's money.
So when that house appreciates by just 5%, the math completely flips. A 5% increase on a $300,000 house is $15,000.
Yep.
But because you only invested $60,000 of your own cash up front, you didn't make 5% on your money. You made a 25% return on your initial investment.
And that is the magic of it. You get to keep the appreciation on the entire value of the asset, even though the bank took on the bulk of the financial burden.
Which is wild.
It creates this profound multiplier effect. It divorces your return on investment from the actual appreciation of the asset itself. The physical house is only growing at 1 or 2% above inflation, but your personal wealth is compounding much, much faster.
Imagine trying to take this strategy to the stock market. Just picture walking into your local bank lobby, sitting down with a loan officer, and casually asking for a 30-year fixed-rate mortgage so you can buy $300,000 worth of Apple shares.
Oh, they'd laugh you right out of the lobby. I mean, security guards would escort you out.
Totally. But the global banking system is uniquely designed to lend against physical property, not volatile equities.
Right, because the house isn't going to vanish overnight. But leverage is really only half of the real estate equation. The source material highlights a second secret weapon.
Which turns it into a machine, right?
Exactly. It transforms property from a static asset, just, sitting in the dirt, into an active wealth-building machine. And that weapon is rental income.
Let's bring back our 1970 factory worker. So he has his $10,000. Instead of buying a standard single-family home to just live in, he buys a duplex.
A very smart move.
Right. He lives in one half and he rents out the other. The tenant in the second unit pays monthly rent, and that capital goes directly toward paying off the worker's mortgage.
Which means he is effectively living for free while someone else buys the asset for him.
It's basically a cheat code.
It really is. The loan balance decreases every single month, equity builds up, and the physical asset quietly inflates in value over the decades. The building serves a functional purpose housing him, while simultaneously generating third-party income.
And that mechanism, a tenant paying down the debt while the asset inflates, is the true engine of real estate wealth.
Oh, it's spot on.
So it sounds perfectly tuned, a machine fueled by leverage and rental income. So if real estate is this unstoppable force, why shouldn't you, the person listening right now, immediately empty your savings account and dump every last cent into a down payment?
Because mechanical systems require constant, often grueling maintenance. The real estate machine is incredibly demanding on a visceral physical level.
Right. The real estate crowd loves to hype up the duplex and the passive income, but they conveniently forget the hidden costs. We're talking about property taxes that arbitrarily jump, massive capital expenditures, insurance premiums.
Yeah, a roof is essentially just a ticking time bomb of depreciation. And HVAC systems have this uncanny ability to completely fail in the middle of a January freeze. It never happens on a nice spring day.
Never. And then there are vacancy periods where you are suddenly covering that massive leveraged mortgage entirely out of your own pocket because the unit is just sitting empty.
And worse than an empty unit is the nightmare scenario.
A single bad tenant.
Exactly. The sources point out that one destructive tenant can cost you months of lost income, thousands of dollars in agonizing legal fees for an eviction.
Not to mention physical property damage. And plus, you are trapped. If you suddenly need your capital for an emergency, selling a house isn't quick. It requires months of staging, inspections, appraisals, closing paperwork.
It is the ultimate illiquid high-friction asset. It is so high friction, in fact, that Robert Shiller introduces a major paradigm shift in the source material.
Oh, I know where you're going with this.
Yeah, he argues that for everyday people, owning a primary residence is actually closer to a consumption expense than an actual investment.
Here's where it gets really interesting. A consumption expense. That completely subverts the traditional American dream where your house is supposed to be your ultimate nest egg.
It totally flips it. It feels like an investment because, well, the sticker price is so high and you're dealing with a bank. But look at the mechanism of where your cash actually flows over a 30-year mortgage.
It's bleeding out everywhere.
Exactly. The staggering amount of interest paid to the bank, the relentless property taxes, the necessary modernizations just to keep the home functional, all of that capital often completely eclipses the raw appreciation you gain when you eventually sell.
So you're basically paying for utility. You're paying for a secure place to sleep, not necessarily building independent wealth.
The core revelation from the data is that the serious wealth in real estate is generated by landlords operating businesses, not everyday homeowners merely existing inside a single-family house.
Okay, so if my primary house is actually just an expensive consumption habit, and I know for an absolute fact that I have zero desire to be a landlord-like, I do not want to answer a 2 a.m. phone call about a broken sewer pipe or chase down late rent What is my alternative?
Right, you want the wealth without the headaches.
Exactly. How do I build wealth without the visceral stress of property management?
That aversion to middle-of-the-night plumbing emergencies points directly to the ultimate hands-off vehicle, the stock market. If real estate is heavy, illiquid, and friction-laden, equities are designed to be practically frictionless.
Let's dig into the sheer convenience of that liquidity, because it's night and day.
The contrast is jarring. You just mentioned how selling a house takes months. In the stock market, you can decide to liquidate your position at 9:30 in the morning, execute the trade with a literal tap on your phone, and the cash is sitting in your account by the afternoon.
Total flexibility. And it's not just about the speed of selling, right? It's the mechanics of what you can actually buy. The source material emphasizes instant diversification.
Yes, which is huge.
By purchasing a single share of an S&P 500 index fund, you aren't just buying a ticker symbol. You are buying a microscopic slice of the profit-generating engines of the 500 largest companies in America.
You instantly own a fraction of Amazon's logistics network, Microsoft's cloud servers, Apple's hardware sales. You do not need to research individual neighborhoods. You don't need to hire building inspectors. You own a frictionless slice of the broader macroeconomic engine.
And this is where we need to explain how this actually turns into wealth. Let's bring back our 1970 factory worker one last time. Let's say he ignored the neighbor's duplex idea. He takes his $10,000 and buys into the S&P 500.
Okay.
The mechanism that makes him rich isn't just the stock price going up on a chart, it's the dividend. When those 500 companies make a profit, they take a chunk of that cash and pay it directly back to the shareholders. It's a literal cut of the earnings.
And the absolute magic happens when he takes that cash dividend and uses it to buy more shares.
Yes. His profit engine grows slightly larger, which generates even more dividends the next quarter, which buys even more shares. That is the actual mechanism of compounding. It's geometric growth.
It builds on itself.
Right. And by doing exactly that, reinvesting every single dividend, the source notes that his $10,000 in 1970 would have exploded to over $1.2 million by 2024.
And think about how that $1.2 million was generated. It happened entirely in the background. He never patched a roof. He never dealt with a squatter. He never worried about a local zoning board. This is the quiet, invisible power of compound interest working relentlessly over decades.
Wow. But let's be honest, it's not perfectly stress-free.
No, definitely not.
The real estate investor loses sleep over a broken furnace. The stock investor loses sleep over the psychology of the market. It takes an iron stomach to hold on to those shares when a global crisis hits and your portfolio drops 30% a week.
That is the hardest part. The screen flashes red. The news is panicking, and the urge to sell and salvage whatever cash you have left is overwhelming.
The psychological difficulty of holding volatile equities during a crash is the exact trade-off for not having to fix a broken furnace. Real estate tests your physical and operational endurance. Stocks test your emotional discipline.
Perfectly said. We've thoroughly mapped the mechanisms of both sides now. Real estate divorces return from appreciation through leverage, generating active cash flow but demanding immense sweat equity. Stocks provide frictionless liquidity and effortless compounding, but require immense psychological restraint.
So this leaves the listener needing a practical framework to actually navigate this choice based on their own immediate life circumstances.
Right, because everyone's situation is different.
Exactly. The source material provides a really clear decision matrix. Let's evaluate where you, the listener, fit into this puzzle. If you are sitting on $5,000 right now and you hate answering the phone, real estate is going to be a nightmare for you.
Absolutely avoid it.
You should lean into equities. You need the frictionless liquidity, the low barrier to entry, and the global diversification. You just need to build the emotional discipline to let the compounding machine run uninterrupted.
Conversely, if you have excellent credit, access to financing, and an entrepreneurial drive to actively hustle, you might lean toward real estate.
Because you can handle the friction.
Exactly. You are willing to take on the operational stress, or maybe sacrifice some margin to hire a property manager in exchange for the ability to drastically multiply your capital using the bank's money in a strong rental market.
But if we connect this to the bigger picture, we uncover the true thesis of our sources. The ultimate secret that institutional investors and wealthy families have known for generations.
And if we connect this to the bigger picture, the debate itself, this endless internet argument of real estate versus stocks, is a false choice.
A false choice.
Yes. It is a manufactured dilemma that keeps ordinary people arguing in circles while the wealthy simply utilize the unique mechanics of both.
They don't pick a side. They build a comprehensive system. The source material uses a building analogy, but let's push it further to see how it actually functions. Think of your stock portfolio as the concrete foundation of your financial life.
I love this analogy.
Concrete is incredibly boring. You can't show it off at a dinner party.
Right.
But it requires zero daily maintenance. It is incredibly stable, and it quietly supports everything else you build.
You absolutely need that dense, liquid foundation before you try to build upward.
Right. Then your real estate investments act as the walls and the roof. They provide immediate utility, they generate cash flow to fund your daily life, and they shelter your net worth from inflation. But just like a real roof, you're occasionally going to have to get up on a ladder in the rain to patch a leak.
It's structural.
Exactly. Together, the zero-maintenance concrete foundation and the high-utility roof don't just build wealth. They create an impenetrable financial fortress.
The liquid wealth of stocks provides ultimate security and fast optionality, while the leveraged real estate provides robust cash flow and profound tax advantages. They are completely different mechanisms serving highly complementary roles.
So what does this all actually mean for you? How do you actually start constructing this fortress today? Our sources lay out a tiered action plan based on where your bank account is right now.
Let's hear it.
If you have under $1,000, do not even look at Zillow. Real estate is entirely off the table. Your only focus should be opening a low-cost index fund and building the mechanical habit of consistent investing. Pour the concrete first.
Build the habit, and then once you accumulate between $10,000 and $50,000, your options dramatically expand.
That's the milestone.
Yeah, you might use that capital as a down payment on a first rental property in a growing market to start the leverage machine. Or if you know you lack the operational bandwidth for tenants, you deploy that capital to significantly scale up your stock portfolio, perhaps tilting toward dividend-paying assets to mimic the cash flow of a rental property.
And if you are fortunate enough to be sitting well beyond that $50,000 mark, it is time to stop thinking like a retail investor and start thinking like an institution.
Diversify.
Exactly. You diversify across both asset classes. You let the invisible geometric compounding of equities and the aggressive leverage of physical real estate work simultaneously.
It is about engineering a system, not pledging allegiance to a side. But before we wrap up, this raises an important question, something that stretches beyond the historical data we've analyzed today.
What's that?
Well, we've spent this entire time treating real estate and stocks as two totally separate financial vehicles. One intensely physical, illiquid, and local. The other instantly liquid, digital, and global.
Right, the concrete and the roof.
Yeah.
But the technology underpinning finance is moving incredibly fast.
It is. We're witnessing the rapid evolution of fractional real estate investing and asset tokenization. It forces us to ask, are we approaching a near future where the rigid wall between these two asset classes dissolves completely? Think about it. Before you empty your bank account into a down payment or lock all your cash into an index fund, consider a world where you can buy and sell a single share of a commercial building in Manhattan or a duplex in Austin directly on your phone at 9:30 a.m.
Taking the tactile utility of property and injecting it with the frictionless liquidity of a stock.
Exactly that. Blending the mechanisms entirely. And if that becomes the new standard, how will it reshape who actually gets to build generational wealth? Will democratizing access to the leverage machine level the playing field, or will it just introduce new, unseen volatilities into the housing market?
That is a fascinating evolution and definitely something you need to keep on your radar as you map out your financial future. The mechanisms of wealth are always shifting, but the underlying physics, leverage, compounding, liquidity, and cash flow, they remain exactly the same.
They never change.
We want to thank you so much for joining us on this deep dive. Our final advice to you: step away from the emotional internet debates over which asset is superior. Look honestly at your own capital, ruthlessly assess your own tolerance for stress, and go out and start pouring your foundation today. We'll catch you on the next deep dive.